as of this week, the stock market of South Korea is officially worth more than the entire United Kingdom. Let that sink in for just a second.
I mean, it's wild to even say out loud.
Right. A nation that built its wealth on heavy manufacturing just, strapped a silicon rocket to its economy and blew past one of the oldest financial empires on Earth.
It really is a historic shift.
Hello and welcome to NovaStream. If you are tuning in right now, you already know we are your 24/7 streaming home for live crypto markets, global financial indices, and the breaking news feed that hits the absolute second it happens.
And you are likely watching the dynamic sparkline charts for Bitcoin, Ethereum, and Solana flashing on your screen right alongside the S&P 500.
Yeah, and the euro to dollar forex pairs too. But right now, we're going to step back from that rapid fire ticker. It's time for the highlights of the day.
And today, the market is presenting us with some massive, irreconcilable contradictions.
Oh, for sure.
The ticker tells you what the assets are doing second by second. But our goal here is to map out why it's happening. Because, well, we're witnessing a market that is aggressively trying to price in this utopian artificial intelligence future.
While at the same time slamming into some very harsh physical and macroeconomic realities. Contradiction is honestly the best way to frame it.
It really is.
So here's a roadmap for you today. We're looking at how AI just reshuffled the global indices, dissecting a massive tech earnings day, checking in on the physical economy, including some brutal words from Lululemon's founder.
Yeah, that was intense.
Right. And then breaking down a brand new SEC crypto rule that has the XRP market totally misreading the tea leaves.
A lot to cover.
So let's jump right back to that staggering statistic that flashed across our indices feed. South Korea leapfrogging the UK to become the world's 8th largest stock market. As of 2026, the total market cap of South Korean listed companies surged over 45%.
Hitting, what, $4.04 trillion?
Yeah, 4.04 trillion. And the UK, it only grew about 3%, sitting at 3.99 trillion. Keep in mind, as recently as the end of 2024, the UK market was double the size of South Korea's.
It's a phenomenal reversal.
Yeah.
And, it forces us to look at the underlying architecture of that growth.
Mm-hmm.
For anyone watching the Asian tickers right now, the benchmark index for South Korea is the Kospi.
Which holds over 800 companies, right?
Right, it does.
Yeah.
But, and this is key, this surge is not a broad-based economic miracle across all 800 of those businesses. It's a structural rebalancing of global equity markets, entirely driven by the AI hardware supercycle. I mean, we saw Taiwan pass the UK back in April for the very same reason.
They reached $4.48 trillion, I think.
Spot on. It's all about the hardware.
Because when we talk about the AI boom, it's so easy to just think about the software, right? The chatbots, the generative models.
Yeah, the flashy stuff.
But none of that exists without the physical silicon.
Absolutely not. To train and run artificial intelligence at scale, you require massive, unprecedented amounts of memory. Samsung and SK Hynix are the two behemoths of high-end memory chips.
And they dominate that index now.
They make up over 40% of the entire South Korean Kospi index.
Wait, really? Just two companies?
Just two companies, driving a massive national valuation surge because they function as the unavoidable backbone of the global AI supply chain.
Looking at the sector breakdown, it makes me think of the UK's FTSE 100 index, like a beautifully restored vintage car.
Oh, I like that analogy.
It's incredibly reliable, it has decades of history, but it's built entirely on traditional, slow-growth legacy sectors. We're talking financials, consumer staples, mining operations.
Right, the old world.
Yeah. Meanwhile, South Korea and Taiwan stopped building regular cars and just started refining the pure rocket fuel for the AI space race.
That analogy captures the ruthlessness of global capital perfectly. I mean, capital always flows to the source of highest potential growth. And right now, global investors do not see the foundries and memory chip makers in Asia as a temporary trend. They view them as a structural, long-term necessity.
A permanent reallocation of wealth toward the infrastructure of tomorrow, which brings us to the U.S. market, because we just had a monster earnings day for big tech.
We really did.
Alphabet, Amazon, Meta, Microsoft, they all beat expectations. Alphabet was the standout gainer, up 7% in extended trading purely on massive cloud growth.
Which makes logical sense, because the cloud is where all this AI processing actually lives.
Right, but I'm looking at Qualcomm's numbers, and I have to admit, their stock movement seems totally disconnected from reality.
The Qualcomm situation is arguably the purest distillation of this future-obsessed market psychology.
They just issued a demonstrably weak June quarter outlook. By all traditional rules of finance, if you tell Wall Street your upcoming quarter is going to fall short of expectations, your stock takes a brutal beating.
Oh, absolutely. It should tank.
Yet, Qualcomm's stock is soaring today. Are investors just hallucinating, or is there a valid reason they're ignoring the actual present-day numbers?
They are actively, consciously choosing to ignore present-day weakness because they are transfixed by a specific future promise.
What promise?
Well, during the earnings call, Qualcomm's CEO, Cristiano Oman, dropped a very deliberate hint. He confirmed that a leading hyperscaler custom silicon engagement is on track for initial shipments later this calendar year.
Let me pause you there. A hyperscaler, so we're talking about one of the massive cloud providers, like a Google, an Amazon, or a Microsoft.
Right on the money. He didn't name the partner, but that one phrase validated the market's wildest optimism.
So the logic is, who cares about smartphones right now?
Precisely. The underlying logic from investors is, who cares if smartphone chip sales are soft this summer if Qualcomm is about to become a critical custom silicon provider for the largest AI data centers on the planet?
It's the ultimate forward-looking trade, but man, it feels incredibly precarious.
It is.
Because if you look at our news feed, analysts are starting to sound the alarm on companies like Intel, warning that the hype might be massively overdone. Shares are climbing on the mere possibility of good news.
Without the fundamentals to back it up. And that raises a critical red flag regarding valuation. When every little piece of potential good news drives shares higher, the market is pricing imperfection.
Which never happens.
Right. You're operating under the assumption that every custom silicon engagement will be a flawless victory, and that the corporate spending on AI hardware will never, ever slow down.
But there's a fatal logical flaw in this utopian AI trade. All those data centers and custom chips require massive physical infrastructure to build.
You still need concrete.
Right. The digital future requires copper, concrete, and physical supply chains today. And when we pull our eyes away from the silicon and look at the companies actually moving the dirt and making the goods, the physical economy, the current reality gets a lot darker.
It becomes significantly messier, yes. And it reveals how fragile the non-tech sectors of the market actually are right now.
So let's start with the bright spot in heavy machinery. Caterpillar is absolutely crushing it.
They are?
First quarter earnings per share came in at $5.54, thoroughly dismantling Wall Street's $4.65 estimate.
That is a massive beat.
Third quarter in a row, they've posted a massive beat, alongside a 38% rise in their construction industry's sales. So physical building is booming, but then I look at the consumer and automotive side, specifically Ford Motor Company.
Yeah.
And their earnings report feels like a calculated mirage.
Well, Ford reported a huge jump in first quarter profit, leaping from $500 million last year to $2.5 billion this year.
Yeah, with revenue climbing 6% to $43.3 billion.
And their CFO called it a solid start.
I'm reading the underlying SEC filing here, and I have to push back hard on that corporate spin.
Let's hear it.
Out of that $2.5 billion profit, $1.3 million, more than half of the entire gain, is literally just a federal import tariff refund. Yeah. Ford paid tariffs, the Supreme Court struck those tariffs down, and the federal government cut Ford a massive refund check. How can they claim business is booming when half their profit is a government rebate?
Your skepticism is entirely warranted. This is why looking under the hood of these earnings reports is critical, rather than just reading the headline numbers.
It's totally misleading.
If you strip away that one-time $1.3 billion refund, Ford's operational profit growth is remarkably weak. I mean, they are struggling through a painful transition to EVs, battling high labor costs, and facing shifting consumer demand.
So they're just masking structural decline.
Absolutely. Relying on a Supreme Court ruling to artificially inflate your quarterly numbers is a symptom of severe vulnerability.
And we're seeing that same vulnerability, that same masking of structural decay play out in the consumer retail space, too. Look at Lululemon.
Oh, the Lululemon situation is fascinating.
The stock has been on a long, painful descent from the highs of the pandemic and early 2024, but now the internal panic is spilling out into public view.
The founder's recent comments were highly unusual for a publicly traded company.
Chip Wilson, the founder, just went completely scorched earth. After a week of silence regarding the company's new CEO pick, he publicly declared that the brand has lost its cool.
He really said that.
He did. He claims they are now stuck catering to customers who only follow generic athletic brands. For a founder to brutally assess their own creation like that, the internal metrics must be flashing bright red.
It's a devastating critique. But, if it's a broader pattern, legacy companies are trying to hide or outrun their structural decay.
Right. Ford uses a one-time accounting windfall to look profitable, and Lululemon is actively bleeding its core brand equity.
It's a stark contrast to the structural, undeniable demand we just discussed with the AI memory chip makers.
And that structural decay in traditional consumer sectors is about to run into a brick wall because the discretionary spending that companies like Lululemon rely on and the vehicle financing that Ford depends on are being aggressively squeezed by the macroeconomic alert that just flashed across our newsfeed.
Yeah. The inflation shock. Yeah. As of this month, April 2026, U.S. inflation has accelerated to a roughly 3-year high of 3.5% annually.
Which is painful enough on its own.
But more concerning for the Federal Reserve is that the March PCE price index, the Personal Consumption Expenditures Index, which is their preferred gauge, surged 0.7%.
This is a massive warning light on the economic dashboard, and we need to explain the mechanics of how we got here, because this is not the inflation of 2022.
Well,
People are not out there flush with stimulus cash, bidding up the price of goods.
that is the most crucial distinction. This is not demand pull inflation, it is a massive supply shock.
Right.
The conflict in Iran has severely disrupted global energy markets. That geopolitical tension translates directly into soaring prices for crude oil.
And oil bleeds into the PCE metrics because energy is an embedded cost in absolutely everything.
Totally. If the price of diesel spikes, the cost to manufacture a good goes up, the cost to put that good on a cargo ship goes up, and the cost to truck it to a retail store goes up.
And that entire chain of increased costs is ultimately passed down to you, the consumer, at the cash register.
Every single time.
Okay, here's my fundamental problem with the proposed solutions to this. If this inflation is entirely driven by an overseas geopolitical conflict spiking the price of oil, how does the Federal Reserve hiking interest rates even help?
It's a great question.
I mean, the Fed cannot print crude oil. They can't lower the price of a barrel of gas by making a small business loan or a family's mortgage more expensive.
You have just articulated the absolute nightmare scenario for any central bank. It's an unwinnable catch-22.
Explain that.
Well, the Federal Reserve's primary tool, the interest rate, is a blunt instrument designed to cool off demand. If they make borrowing incredibly expensive, people stop buying houses, companies stop expanding, and prices eventually fall.
Sure, in a normal cycle.
Right. But when inflation is caused by a broken supply chain or an energy shock overseas, crushing domestic demand does not fix the underlying supply problem.
It just punishes the average consumer twice. First at the gas pump and then again at the bank.
It forces them into a corner. If they hike rates further to fight this 3.5% inflation, they risk plunging a relatively resilient U.S. economy straight into a recession.
Suffocating the housing market and freezing corporate lending.
Exactly. I mean, absolutely. But if they cut rates to give the economy some breathing room, they risk letting that supply shock inflation become deeply entrenched in wages and long-term expectations.
Which perfectly explains the heavy volatility we're seeing on the global indices today. Investors are terrified of stagflation, that toxic combination of low economic growth and high inflation.
It's the worst-case scenario.
Speaking of assets that absolutely hate macro uncertainty and regulatory shifting sands, we need to pivot to the live crypto markets.
Yes, let's look at the crypto ticker.
If you're watching the NovaStream feed, you'll see XRP has dropped about 5% today, currently trading around $1.36.
And this drop is being driven by headlines scrolling across the news feeds claiming a brand new SEC 85% rule is going to severely slow down or even halt the approval of XRP ETFs.
So, if the headlines are screaming about a new rule ruining these funds, but the new SEC chair, Paul Atkins, is known for wanting to make the approval process easier and more standardized, something isn't adding up.
You're right to be suspicious.
Break down the actual mechanics of this proposed rule for us, because I suspect the market is reading a bearish headline and panic selling without understanding the fine print.
The market has fundamentally misread the situation. Let's look at Paul Atkins' agenda. Since taking over, he has pushed for standardized universal rules to replace the SEC's old system of case-by-case arbitrary denials. To execute that, the NYSE ARCA filed a proposed amendment. This new rule requires any commodity-based trust, which includes crypto ETFs, to hold at least 85% of its net asset value in what they call qualifying tokens.
Okay, and how is a qualifying token legally defined under this new framework?
A qualifying token is defined as any cryptocurrency that has at least 6 months of regulated futures trading on U.S. markets.
So Bitcoin meets that standard?
Yes. Ethereum meets that standard. Solana meets it. And crucially, XRP meets it. It is specifically named in the documentation as a qualifying asset.
Wait, so if XRP is officially recognized as a qualifying asset, why the 5% drop? Why are investors dumping the token today?
Because of the leverage side of exactly how these funds operate. To understand the panic, we have to look at who the actual winners and losers are under this proposed mathematical framework.
Okay, let's start with the winners.
The clear winners are the 5 existing spot XRP ETFs currently trading in the U.S. We're talking about the funds from Bitwise, Canary, Franklin Templeton, 21 Shares, and Grayscale.
Right, the funds that just take investor cash, buy the underlying token, and hold it. No leverage, no tricks.
Correct. They hold pure XRP. Because they do not use derivatives or mix in non-qualifying assets, they are 100% qualifying.
Wow.
Together, these 5 funds hold $1.05 billion in net assets, and they have seen $1.29 billion in cumulative inflows since November 2025.
So this new SEC rule does absolutely nothing to disturb their operations.
Nothing at all. In fact, it secures their status. It also acts as a massive tailwind for multi-asset trusts, like Grayscale's digital large cap fund.
Which holds a basket of tokens, right?
Yeah, that fund holds Bitcoin, Ethereum, XRP, Solana, and Avalanche. Since 4 of those 5 assets qualify, it easily clears the 85% threshold and gets a much faster, standardized route to the public market.
Okay, so if the standard spot ETFs are completely safe, who are the losers triggering this headline panic?
The losers are the highly leveraged ETFs that rely on heavy derivatives exposure to multiply their returns. This is where the SEC's math gets highly restrictive.
How so?
Under the proposal, options and futures positions count toward that 85% threshold at their full notional size.
Notional size. Let me see if I have the mechanics of this right, because it feels a bit like trying to qualify for a mortgage.
Go on.
The bank doesn't just look at the, say, $20,000 cash you have for a down payment. They assess your overall risk based on the full $400,000 value of the house you are buying. The SEC is doing the same thing to these leveraged crypto funds, right?
That is an excellent way to visualize the mechanism. Let's apply that to a 3x leveraged ETF.
Okay.
Say you're building a fund, and you start with $100 in underlying cash. Through the use of complex derivatives and futures contracts, you gain $300 worth of market exposure to XRP. Under this new rule, the SEC does not just look at your safe $100 cash base. They look at the full $300 of market exposure. Because that full $300 counts against the total threshold, a highly leveraged fund instantly breaches the 15% allowance for non-qualifying risk.
Ah, so it is essentially a mathematical trap designed to kill heavily leveraged products.
It is a deliberate, highly engineered risk management standard. Granite Shares is the clearest casualty of this.
Right, they're proposed 3x long and 3x short XRP ETFs.
Yep. They have been delayed 5 separate times since early April. The SEC has been pushing back on 3x crypto ETFs for months, citing older regulations that cap fund leverage at 200%.
Because XRP is already incredibly volatile on its own.
Highly volatile. Its annualized volatility hit an astonishing 95.5% between 2020 and 2025.
That's insane.
So the SEC is drawing a line in the sand. They simply do not want a 3x leveraged product of an asset that volatility hitting the retail market without massive structural safeguards.
So, to summarize this for everyone watching the NovaStream crypto ticker, the headlines claiming XRP ETFs face delays are entirely misleading.
Completely.
It is only the extreme 3x leveraged derivative products that are in trouble. The standard hold the asset spot ETFs are perfectly fine, and this rule actually legitimizes XRP on the same level as Bitcoin and Ethereum.
That is the reality on the ground. When you strip away the panic, the 85% rule is a massive net positive for the institutionalization of the asset class.
So as we track this, there are 2 key dates our viewers need to watch. May 7th is the absolute deadline for the Granite Shares 3x ETF. They'll either be forced to launch or get slapped with a rare 6th delay.
And May 19th is when the public comment window finally closes for NASDAQ's parallel rule filing.
Right. Those 2 dates will tell us definitively if the SEC is moving forward with this standardized framework.
Keep those dates circled. They will dictate the short-term price action and the long-term regulatory landscape.
So what does this all mean when we put the macro pieces together? We're looking at a deeply fractured, almost schizophrenic global landscape.
Pulling in 2 opposite directions.
On one hand, you have hundreds of billions of dollars rushing blindly into the AI supply chain, literally pushing the economies of South Korea and Taiwan past the United Kingdom, all based on the utopian promise of endless tech growth and future custom silicon engagements.
The market is pricing in a flawless digital tomorrow.
Right. But on the other hand, the physical present is an absolute mess. You have legacy heavyweights like Ford relying on Supreme Court tariff refunds to fake profitability, Lululemon's founder admitting the brand is bleeding its identity, and the entire broader economy being suffocated by a supply shock inflation spike driven by geopolitical conflict in Iran.
Yeah, add in the regulatory maze of the crypto markets, and it feels like something has to break.
It paints an incredibly complex picture.
And it leaves us with one critical, overarching question to consider.
What's that?
Well, we're witnessing hundreds of billions of dollars flow into this AI supply chain under the rigid assumption of endless exponential growth. But if geopolitical conflicts keep energy prices sky high, and that inflation forces the Federal Reserve to keep the broader physical economy in a permanent chokehold of high interest rates, eventually, will the massive pools of capital required to fund these future-looking AI silicon projects start drying up?
Wow. That is the trillion-dollar question right there. Can the AI rocket ship keep flying if the gravity of the physical economy keeps getting heavier and heavier?
Something to think about.
Definitely something for you to ponder as you watch the red and green on the screens today. Thank you so much for joining us for the highlights of the day. Remember, NovaStream is streaming 24/7 with live market data, breaking news, and real-time index tracking. Keep your eyes on the ticker, stay informed, and we will catch you next time.